Alright, I'm going to go over the equity 5 minute chart. So the bottom chart is the Dow, and the top chart is also it's just a different equity index that I constructed. The basically what I want to make sure is that they're in harmony with each other. There should be no divergence. Okay, that is very important. You could also just use the internals, market internals. That could be used as well, or any type of index like the one I created here. Anyway, so remember, no divergence. Alright, so you have the bottom chart, that's the Dow, it goes up on 33 minutes, it just goes straight up. Now you don't have a signal here, but you have the signal on the equity index showing you that, hey, this is demand. Okay, now this doesn't mean you just see a signal and trade a signal. All signals are subject to judgment. All they do is nothing more than to show you a fact. Okay, just a fact. That's the idea. Also, because mechanical signals, they will not work. But fact is a fact is a fact. So that's the idea. Anyway, so the rally yields on the bottom chart on the Dow, and the top chart is the equity index, which is a synthetic index. All right. So the bottom chart, you have 70 minutes drawing out 33,000 contracts, and then it starts going sideways. Now over here you have 40 minutes drawing out 16,000 contracts in the synthetic index, and that is demand. Why? There's a lot of volume. Someone's buying the low. All right, that's our presumption. Okay, then it starts moving sideways, and this is the funny part. It goes up, whereas the Dow goes down. Okay, this is going up. The Dow is going down. It means that there is a divergence between the two, and if you're just looking at the Dow, you basically will not you're not going to get the right picture, because the Dow is showing 12,000 down on 55 minutes, and that is supply. But what they're doing is they're selling in order for this to occur. Alright, now someone can call it a spring or a test or whatever. Or, in hindsight, it looks like effort reward, right? But in the moment, it looks like supply. You have a market, supply comes in, the idea is, hey, it's going to pull back and test all of this, this area. Very likely it's going to test. But the top chart, the equity index, is going up. It is green. The bottom chart isn't. They are diverging. So who's telling the truth? Who is telling the truth? Well, there's two scenarios. The first is that the Dow is not this is not supply, and that the equity index is right. The second scenario is the Dow is leading and the equity index is going to follow. Okay? That's the second scenario. But given the fact that when we were at this point, the market is up here making new high, up here, it is very unlikely that the Dow is leading the rest of the indexes down. Okay? Very unlikely it's doing that. And if you're uncomfortable with putting on the trade, long or short, all you gotta do is just wait it out, or don't. When in doubt, this is the moment. Like, when in doubt, get out, or don't put it on, or whatever the saying is. this is that moment, and you can clearly see the divergence between the indexes as a whole versus the Dow, right? And then later on, oh yeah, it's F for reward, blah blah blah. But when it's this clear, you know there's just something wrong with the situation on the Dow, and that there's something wrong with it. These guys, whoever's selling, they're gonna come right back in and get. They have no choice. They have to cover, even if they did sell up here. Okay. So this approach, it's really from the Wyckoff method. Wyckoff method, when you trade a stock, you're supposed to have a stock and then the market. And then what Wyckoff says is there can be no divergence between the two. Okay? He says there can be no divergence between the two. Meaning the market is going up, you get a stock that's going up. And not only do you get a stock that's going up, you get a stock that is stronger than the market. And how do you tell? Well, on a minor pullback within the market, the stock is holding. So that means that there's bag holding in the stock. So without going into that approach, a similar idea can be applied to other markets as well. If you're trading the mini, you can use an equity index, a synthetic equity index, or a Wyckoff wave, or whatever, and create your basically index, okay, of leaders, right? That's what most people do. Or you can compare the S&P to the Nasdaq or something like that, or you can create a spread between the two, Nasdaq minus S&P, or relative strength of Nasdaq versus S&P, or whatever. But the idea is, those are just implementation. The idea is that there can't be any divergence between the two. They all have to be in harmony. Okay? And for many reasons, sometimes they say, rising tide lifts all boats or something like that. But whatever it is, you want to make sure you have the trend and the bias in your favor. If you don't, you're screwed, because there's too much. It's very easy to manipulate a single market, all right? But it's not as easy to manipulate multiple markets, manipulate everything. So you want to keep that in mind. Similar with gold, like how would you apply this to gold? A lot of folks, when they apply it to the stock market, they're going to probably use the market internals, or something else, or look at the leaders, like Apple and Facebook and momentum, high beta stocks, also spreads, etc. But what about when it comes to gold? What the hell do you do if you want to trade gold or oil? And a lot of these guys, they have their own approach. Oil traders, for example, they're watching different spreads, they're watching front month, back month, whatever. They're using a lot of different, I think some of them also, you look at the option market. And you can get that data also to see, all these statistics. And for gold, there's also approaches that people use. Some of them might be looking at the, I think it's the HUI or HWI, I forget which one it is. But they might be looking at the gold miners. They might be looking at, there's also, I think it was unhedged stocks that have the most exposure to gold. Anyway, there's multiple things, but in the Wyckoff approach, you can just look at some type of precious metals index. Okay. For oil, you can look at the energy sector, or just energy. You can create an index, basically. All of this is all coming down to one thing. The whole point is, in the Wyckoff method, you want to see the overall picture, meaning you want to see everything and then see your little thing, your market in that sector or in that group or in the market. And then what you want to make sure is that you're part of that rising tide. Okay, whether it's going up or down, you're part of that, and you're in that same direction. Okay. So I don't know. These pictures look weird, but that's the idea. So a lot of folks will say, well, what do I do when I trade the mini Dow, or what do I do when I trade the S&P? Well, one of the things you can do is use some type of index or a spread or something, or internals, or etc. That will help, because one market, in my opinion, gives the wrong picture. As you can clearly see over here, you have the Dow, 12,000 contracts traded, 65 minutes down, and look what happened. So there needs to be some way of comparing, some type of confirmation, something that allows you to make a better judgment. Because if you just trade it by itself, a market can give you wrong information. And any single market is very easy to manipulate. You have people with a lot of money who can push it a little bit here or a little bit there to create a signal. Alright? They can do that. But it's much difficult to push the entire pack in one direction or the other. And as you can see here, the entire pack was giving you a demand signal, which you should look at to see if it's real or not. Apply judgment. And then it goes sideways until it's only going down 5 minutes on 2, does a spring, and bang. Similarly, it does this here. Alright, that's all I had. Thanks.